This video will walk us through the multi-step income statement. Again, we're still focusing on the continuing operations section, that top section of the income statement, but now we're going to focus at a little bit more complex method of putting it together, which is the multi-step format. Again, same rules before with interperiod tax allocation, so income tax is calculated once for the entire section. But in the multi-step income statement, as compared to a single step, we're going to get a lot more detail. There's a lot more work to be done with how we're going to break out all of the items within the section. So the multi-step format is broken out into two major categories. We've got operating activities and we've got non-operating activities. They're reported separately within the same section. So again, it's just continuing ops, but we've got two major categories now, operating and non-operating. And they're quite self-explanatory, right? Obviously the operating section is the core of the business. This is what we do on a day-to-day basis. So it's the revenues and the expenses that are generated in our regular business operations. So common items include net sales, cost of goods sold, selling expenses. This could be commissions and wages, depreciation on selling equipment, okay, advertising costs. Admin expenses can include office salaries, supervisory salaries, the president's salary, depreciation on office equipment, any of those types of things, right? This is what we do. So imagine we're a furniture manufacturer. This operating activity is all the revenues and expenses that are required to make and sell furniture, right? So the revenues that we generate are going to be the revenues from the sale of furniture, right? The expenses that we incur and that we record are going to be the expenses incurred to manufacture the furniture, market it, and sell it, okay? It's only relating to the ops. Alternatively, we have a secondary section which is called the non-operating section. And the non-operating section, while it's still part of continuing operations, it's ancillary to the day-to-day business. So if we take a look at that furniture manufacturer, let's say that we have a really, really good year, okay? And we generate a lot of extra cash flow. So what we do is we invest that money in a GIC, and we earn a little bit of interest revenue, okay? So now we've got this interest revenue. You have to think, is our core business investing funds and generating returns through interest and dividends? The answer is no, right? The only reason that we were able to make that investment is because our core business was so strong. But the interest revenue, that investment revenue that we make, is ancillary. It's outside of our day-to-day operations. Therefore, it's non-operating, right? Just like the gain on the sale of assets. If we have assets that we're no longer using in operations, when I sell those assets, right, again, think, we're not in the business of buying and selling fixed assets. That's not what we do. We make furniture. Yes, the gain did occur because of the fact that we make furniture and therefore we had the piece of equipment, but our business is not the manufacture, is not the purchase and sale of fixed assets. So the gain itself, while it's still part of continuing ops, it's not part of operating activities. It's non-operating. Okay, so that non-operating activities are ancillary to your day-to-day operations, and they're broken down into two sections. You'll notice that you're going to have two separate headings in your non-operating activities. The first is other revenues and gains, and common items that you'll see in here, like have already been discussed, are the gain on sale of assets and any type of investment revenue. Could be rental revenue, could be interest revenue, dividend revenue. Those are all common things you'll see in a non-operating section, right? Again, rental revenue. Unless we're in the business of purchasing property to rent for the purposes of renting it out, it's not our core business. It's not what we do on a day-to-day basis. Therefore, it's considered other revenues and gains. Other expenses and losses are the same thing, right? Interest expense. While we may have had to take a loan out to purchase equipment, again, we're not in the habit, or we're not in the business of borrowing money and lending money. So that interest expense is ancillary to our day-to-day operations. And then any loss on the sale of assets. It's the same argument for the gain. We just didn't make out as well and we had a loss on the disposition. It's ancillary to what we do on a day-to-day basis. It's not part of manufacturing and selling furniture. It was the result of selling off an asset. Okay, so we've got two sections. We've got our operating section and our non-operating section. And the most difficult thing for us is to be able to establish and identify what goes in each section. Okay, so here's an example of a multi-step income statement. Every multi-step income statement is going to start the same way. Okay, you're always going to, if you look at the very top here, we've got Notting Hill Hotel income statement for the year ended. You're always going to start with your sales figure, right? And this is the operating activity section, starting with net sales. Now they've got net sales listed here at $2.4 million. You might provide additional details by showing me the gross sales, less sales returns and allowances or sales discounts to get to net sales, right? But at the end of the day, every statement starts with this figure here, net sales. And then we subtract our cost of goods sold to get to gross profit. These three line items here, and this could even work for a this could work for a service-based company as well, not just a manufacturing or a commodities or goods-based company as well. It could work for a service-based company. So we're going to start with our net sales, subtract our cost of goods sold, and that will get us to gross profit. After that, we can start to list the rest of our operating expenses out, all of those things that I mentioned on the other slide. Now, how we group them is going to be based on whether I've asked you to do it by nature or by function. Okay? If you don't remember that, go back to the text. By nature and by function is a methodology behind how we can group together our expenses. So by nature is by the type of expense that it is. So I'm going to group all of my wage expenses together, regardless of whether they're selling or regardless of whether they're admin. I'm going to take all my depreciation and I'm going to lump it together, regardless of whether it's selling or admin. Right? Function, if we're grouping expenses by function, we're going to group expenses by functional area. Okay? So we might group all of our selling expenses together. We might group all of our general and admin expenses together. And you can see an example of that here in this multi-step income statement. They haven't grouped all the wages together and all the depreciation together. They've grouped things by functional area, by selling and by admin. So this statement is grouped by function. Okay? So what they do is we take net sales minus cost of goods sold to get to our gross profit. Then we list off the rest of our operating expenses. They've grouped them with selling and admin, so the total of that is $500,000. Okay? So the income from operations from our operating activities is $300,000. Obviously, you're going to want to see a high income from operations. This is the core of your business. This is what's going to exist next year, and therefore you want this line item here, this income from operations, you want that to be a very strong number, right? The more of your income that's generated from these other revenues and expenses and other expenses and losses, other revenues and gains, and other expenses and losses, the more that's generated from that section, the more volatile your company, because you can't guarantee that you're going to have that interest revenue there yet next year. Perhaps that interest revenue is based on a GIC that you've had some extra money and you put some money in a GIC and you're earning some interest revenue. Well, what happens next year or next quarter if you need to withdraw the money from the GIC to invest in a plant expansion or to replace some old machinery that has broken down and needs to be fixed or replaced, right? That $120K could disappear a little bit. It could disappear altogether. It's not going to be there. But if this is obviously a hotel, they're still going to be renting out rooms. They're still going to have sales revenue from renting out rooms. Okay, so the most important section is this income from operations, this section up here, going from the $2.4 million down to the $300K. Now these other two sections, I said, in the non-operating activities has two headers. You've got other revenues and gains, and you've got other expenses and losses. And you can see that they've got some investment revenue here. It's interest revenue for $120K. That's ancillary to the day-to-day business, just like we talked about. Okay. They also list out a couple of other expenses and losses. They've got a loss on sale of equipment and a loss on some interest expense. Okay, so they subtotal those two items together, right? And you could put additional subheadings in here if you want, subtotals. Like you could have taken 300,000, added the 120 to get to a subtotal of 420 right here. It's not required. It's totally up to you, your personal preference. Okay. And then you could have taken that 420 and you could have subtracted the 95,000 and that would have still gotten you to 325. So again, it's just presentation. How do you want to see it? But at the end of the day, Notting Hill Hotel Corporation had income before income taxes of $325,000. They then subtract your income tax expense, right? Okay, and this can either be given to you as a dollar value or it can be given to you as a percentage. If it's given to you as a percentage, you're going to take that percentage and multiply it by the income before tax. So let's say the income tax expense was at 25%. You would take $325,000, multiply it by 25%, and that's how you would get to your income tax expense. Okay? I'm not saying that this was calculated at 25%, I'm just giving you an example. Okay? So when we subtract our income tax expense from the income before taxes, you end up with your net income. Okay? And then one thing you'll notice here is this EPS, right? And we talked about that in the first video. EPS has to be calculated on the face of every single income statement. Okay? So make sure that you show me that EPS calculation. I need to see it. It's minimum disclosure. It has to be on the face of every income statement. Okay? And if you remember back to the first video, we may have to do the calculation more than once. Okay? So that's the format of the income statement. We've got, we start with our net sales, we subtract cost of goods sold to get to gross profit. That's the same way every single time. Then you go into the rest of your operating expenses. Again, this example has them grouped by functional area, right, to get to our income from operations. And then we deal with our non-operating activities, which is other revenues and gains and other expenses and losses. So you can see there's a lot more detail here for our financial statement readers, but there's also a lot more work. So obviously the advantage is that when we report operating and non-operating activities, our financial statement readers are going to get quite a bit more information from us. This set of financials is a little bit is a lot more usable by them because it gives them additional information. It's giving them the breakdown between operating and non-operating. They can start to make some more informed, intelligent decisions about our performance, about whether or not they may want to invest in us, whether they may want to sell their investment in us. Okay, but by giving them additional information, they can make better judgment or better investment decisions. The disadvantage is that it's obviously more difficult and more time consuming. We have to be able to differentiate between our operating and our non-operating activities. We've got quite a few more steps in the presentation, so it's a lot more involved, can take a lot more time, and potentially for some smaller companies it may not be worth the hassle, right? The return might not be there on the time investment to get their statements done this way. So those are the advantages and disadvantages, why you might want to do it and why you might not. So that's the end of this video.